Welcome back to Money, Money, Money. This week, we're trying to assess the impact of volatility and the way to get around it. Although asset allocation is one of the cornerstones for achieving an objective, it only works if the allocation is adhered to over time and through varying market environments. Pankaj Mathpal of Optima Money Managers is helping us understand the portfolio dynamics in these tough times. So Pankaj, we've spoken a lot about how the portfolio should be managed, how asset allocation should be managed. But tell me one thing, in times like this, is cash really part of asset allocation? Should someone actually be sitting on cash right now despite not having fulfilled the objectives of their allocation?
There are some important points. One is cash for contingency. That is, always you must have some cash for contingency.
Right.
When market started performing well, retail investors, they invest whole of their money into equity, and when the markets are volatile, and then they realize that mistake. But what I'll suggest you that only for that emergency you should have. Rest definitely should invest. Now there are two questions, whether invest the whole amount together or in the staggered manner. So I'll suggest that it should be through the systematic method, maybe SIP or STP, whatever, because I understand and I know there is a sale in the market right now. You have opportunity to buy stocks, but still nobody knows that how long the sale will last. So considering that, I'll say that you should have cash with you. So if opportunity comes your way, you should definitely invest. So in a staggered manner, start investing, but don't hold it. Don't think that no, when the market will be bottom out, then only buy. So nobody knows what is the bottom. I feel that is fairly valued, and you should start investing, but not the entire amount, but in next few months or few days. Let's see how long this sale lasts, and you should start investing. That is important.
Yes, it's over a staggered period of time.
Exactly.
Okay, in times like this, the other important thing is the way news impacts our investment, right? Now, news could be either domestic, it could be global. I mean, in today's world, global news impacts us as much as domestic news does, right? How much should a retail investor pay heed to news items, I mean, over a longer period of time, which is what the advice is for the small investor? Over the longer period of time, does this news really matter? Does it impact anyone's portfolio at all? No,
not at all, because if the stocks you are buying are fundamentally good, so this news will not have longer impact. So because we are discussing much about retail investors only, I think that they should not pay any attention to these news. You invest regularly in systematic manner and remain invested. See, worst thing is that whenever this kind of correction happens or market are not doing well, that moment people stop their investment, and even SIP investment, as I said earlier also, it is for long term. People cancel their SIP, redeem their units. So don't pay attention to news, stick to your goal. Whatever the proper asset allocation, you should follow that. And if your mutual fund scheme or stock, whatever it is, if you believe that a fund manager has helped you getting consistent returns, so it is only a matter of some time. Definitely you will get returns in long term. So whether stock or mutual fund, whatever it is not based on news. If things are good, if scheme is good, stocks are good, hold it in your portfolio, and there is sure that in long term you will get the benefit.
All right, so is that the reason, I mean, emotions, right? Is that the only reason why there aren't many more millionaires out there? I mean, after all, in the long term, the trend is always up.
Exactly, fully agree with you, because if you see that 2008-9 also, if people who started investing earlier than that, and in that also they continued their SIPs, though there was time, I remember that SIP returns were also negative. But if you continued investing during that period, today definitely you are at profit. So long term is all risk. Only the risk if you are investing in a company and the company is sick and you cannot recover that, then there is a loss. But otherwise, if the company is fundamentally good and it's a matter of time that it may be undervalued or not giving good returns over a period of time, but otherwise fundamentally good company, it will definitely give you returns in long term. So as you said, it is only some emotional biases that people take wrong decisions. There is herd mentality. There are some group behaviors. So because of that only, people don't make money. Otherwise, historically, if you see, equity has always performed better than any asset classes.
Yeah.
But still, I'm not saying that one should hold the entire portfolio in equity only. There is importance of other asset classes as well. In last year, 1 year, if we see, equity has not performed so well, but that has given much reasonably good returns. So I'll say that there is importance of proper asset allocation. But yes, equity is means historically it has given better returns, and I expect that in future also equity will be the best asset class for growth of your money
and long-term wealth creation.
Exactly. So considering these facts, you should have all the assets in your portfolio, but equity should be in higher percentage of your portfolio.
Okay, so you raised actually a very valid point, which is of this dynamic asset allocation, like say between equity and debt, right? Is that the way to go, or should one look at perhaps like a dynamic fund or one of those balanced funds?
See, Sumera, there are two things. If you have time, you have knowledge, then there is nothing wrong doing your own things. See, it is simply that if you know driving and you like driving, you have time for that, you take your own car, you ride your bike. But if you feel no, you don't have much time and somebody is more expert than you, let him drive. So both the things are equally good, but because for retail investors, there are two reasons. One is that lack of knowledge, limited access to research and time. Because if somebody is in job, working whole day, what is happening in the market, where the opportunity comes, they are not able to follow it. So why don't you leave it on the fund managers? In India, many mutual fund schemes are doing fairly well, and they have proved it that they can deliver better returns than the broader market. So I feel that for retail investors, mutual funds are better way of creating wealth than the direct stocks. But saying this, I don't say that one should not invest in direct stocks. If somebody thinks that they have better knowledge and they can get better returns, one can do it. But my experience with my investors and with market, these fund managers are doing better job.
All right. On that note, Pankaj, thanks very much for joining in. We wish you a very happy new year. And even though it might have started on a bit of a downbeat note, I hope things pick up from here.
Thank you very much.
Thanks very much for joining in. All right. So clearly the secret to surviving and potentially thriving during market volatility and weakness may not be how much you know about the current events, but how you react to them. And most times, patience really turns out to be a virtue in hindsight. Let's take a break. Still ahead is our tip of the week.